The market's been hitting new highs, interest rates remain elevated. What does all this mean to your investment portfolio, to your retirement plan? Should you be excited or should you be fearful? That's what we're going to talk about in today's episode.
Welcome to the Your Life, Your Money podcast with Scott Searns, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of The Retirement Show, all about your life, your money, and your retirement. I'm your host, Scott Searns, and my goal is to help you thrive in life, wealth, and retirement. And today we're going to do just that by talking about some, I'll call it recent events, recent headlines. We're going to talk about the market's hitting new highs. What does that mean to your future, to your retirement? And also about interest rates. Maybe you've heard about the Federal Reserve and what they're thinking about interest rates and interest rates cuts and holding them steady. So we're going to talk about that as well, what that means to your retirement. And then we're going to end with a listener question about constantly going in circles about financial decisions, how to make the circles stop, and being able to come to a decision in regards to some specific questions on their retirement. So stick around to the end for that listener question as we'll cover it there. But before we dive in and get started, we're recording this actually just after the Super Bowl. Really good game. But how cool was it that in the Super Bowl, and very unique, right? 2 records set in regards to the same thing. How the length of the field goal. Let's see, we've got the 49ers. It was Moody, 55-yard field goal, setting a new record. And then later in the game, only to be beaten by the Chiefs, Butker, who kicked a 57-yard field goal. So really cool in regards to that 2 record set. Speaking of records, we're also kind of in the week here. So my wife, Christy, she graduated from University of Iowa. So we've been following Caitlin Clark, and how cool if, I think right now she's looking to beat an NCAA scoring record. So we've been kind of keeping our eye on that since she's an Iowa grad. I'm an Illinois grad, but hey, support her school. And so it's been fun to watch their women's basketball team right now, and potentially set those new records there. And then, hey, as we're talking about records and just kind of throw it in there, hopefully we'll get you to subscribe. But talking about our YouTube channel, continuously setting new highs with subscriber counts. So we appreciate you listening. I know maybe you're listening on your favorite podcast channel, but also we have a YouTube channel. So if you want, go check us out on YouTube. You can check us out there at Searns Financial Group. That's SIERENS. Searns Financial Group. Check out our YouTube channel. We have this podcast actually in video recording format on our YouTube channel as well. We pull up different websites and whiteboards and everything like that throughout the podcast or in our different videos. So you might want to check the video podcast as well. So in spirit, with all of these records being set, one of the things that I wanted to go over today is talking about the market. And the market also is setting records by recording new highs. Now, if you take a look at this right here, this is Yahoo Finance. Now, for those that are just listening, what I'm doing is showing a picture of the market over the last 2 years, and you can see that the market, the S&P 500 is what I'm talking about here when I say the market, had recently surpassed 5,000. Now, S&P 500, measure of the 500 largest stocks in the U.S. You can't invest directly in the S&P 500, but you can pick a fund that replicates or tries to replicate the S&P 500. So why am I bringing this up today? Well, the market is setting records as well. It's hitting new highs, which means that we're going to continue to see headlines in regards to those new highs and in regards to what the market's doing, because it gives the news channels something to talk about. So what I want to talk about is to, kind of get rid of all the noise and just really focus on what do new market highs really mean to you? What do they mean to your retirement? And should we be excited or should we be fearful? So first, we're going to talk about markets. Then we're going to talk about interest rates. So where are we at today. When I say today, I mean relatively close to when we're recording this, which is the middle of February. But where are we at? The market, when I said, set some records, hit new highs, on February 9th, it actually closed over 5,000. And I think it's important to understand, well, where did we come from? Or when was the last time it hit highs like this? The actual last, we'll call it major peak in the market was around January 3rd of 2022. So back to and you can go to Yahoo Finance if you want, but looking at the S&P 500. So our last major peak was kind of like right around January of 2022. And then we've been in a bear market ever since. So if you think about that, that's about 2 years that the market's been down. And think about how you felt last year at this point in time, right? So January of 2023, I remember meeting with a lot of different clients going, man, our accounts are down. This doesn't feel well. How long are we going to be in this bear market? Everybody was talking about recession. Everybody was, I want to say the percentage of chance of the fact that we're going to have recession was actually pretty high. So everybody's thinking, boy, the market's going to go down even more. And it just goes to show we're not ever sure what the market is going to do tomorrow. Now, history has shown, right, this upward trend or upward track when it comes to the market, but we're never really sure what it's going to do tomorrow. So last major peak, January 3rd, 2022. So that trough was October 12th, 2022, 282 days from peak to trough. And then think about this, 746 days from peak until we got to a new high in the S&P 500. And so you might think, well, gosh, was that a long time? Was that a short time? Again, back to that blog post that I'll link to, kind of just sits right in and fits in there. If you look at, let's see here, 2007 through 2009, that was 1,997 days from peak to peak. 2000 to 2002, that market correction, 2,623 days peak to peak. And then let's just grab another one here in the 80s. 1980 through 1982, 705 days, 87, 701 days. So as you can see, it kind of just fits in, right? There's no time frame of how long each of these are going to take. Now, why might the market be doing so well? Why was everybody, proved wrong? Not everybody, but why were a lot of people who were calling out recession last year, why were they proved wrong? Well, it's one thing is the economy is actually doing very well. You look at some different economic indicators and it says that our economy is doing well. Unemployment is low. Companies are selling products. Part of the reason why is because there wasn't a recession last year. And another reason maybe why the market's doing so well is because the rate hikes ended. When I say rate hikes, that Federal Reserve interest rate that we'll talk about in the next part of this section. So what does all of that really mean to you? When you see how the market's doing now, the market's at new highs. If you're in equities, meaning in stocks or stock funds, most likely means that your funds are up or your stocks are up, meaning that your 401k balances are up, your IRA, brokerage, Roth, any type of investments that you have that are in equities, most likely those balances are up. Now, you might be looking at the market and looking at your accounts and going, hey, why the difference though? I heard that the S&P was up a certain percentage. Why are my accounts not up that same percentage? Well, that might depend on how you're diversified. So if you think about all of your investments in a pie, well, maybe some of those investments are in US equities. And that would potentially mimic the S&P 500, depending on how you're invested. But maybe some of it's also in small company stocks, or maybe some of it's in mid-cap stocks. Maybe some of it's in international. Maybe you've started, carving some off into less volatile funds like fixed income funds. And if so, those all could have performed differently than what the S&P 500 did last year. So that's why if you're looking at your overall performance, it might have been different than the S&P 500. So back to it, right? The market's up. What does this mean to us? And if you think about, maybe you've heard Warren Buffett's quote, right? Be fearful when others are greedy. Be greedy when others are fearful. So does that mean that we should stop investing? Does that mean like, are other people greedy right now? You know, we're not really sure on that, right? The market's doing well. Does it feel like there's some sort of euphoria out there? I wouldn't personally say that or feel that way right now. But you know, we each have kind of our own opinions in regards to what might be going on. So what should we be doing? Will it keep going up? When it hits new highs, can the market continue to hit new highs? Or should we be fearful of potential recession, potential market crashes? And you're going to see articles in the news, the headlines, the on your phone, wherever you look, right? Wherever you get your news, you're going to see articles pushing both types of scenarios. So instead, I just want to kind of give you some, I'll call it historical information here in regards to what's happened after the market has hit new highs. So let's take a look at this first one here from Wealth of Common Sense. And for those of you just listening, I'm going to do my best to explain it. But this was, I thought, a really good chart showing returns. So after a major decline, it's saying returns from new all-time highs after a bear market. So you hit the new high. What are the 1 year, 3 year, 5 year, 10-year returns after you're hitting after you hit that new high after the bear market? What happens over those next so many years? And just for those of you that are listening, if you look at the chart here, you see a lot of green meaning positive returns, positive 1 year returns, positive 3 year returns, positive 5 year returns, positive 10-year returns. Again, after a bear market, once the market hits that new peak, that new high, we're seeing positive returns 1 through 10 years. Now, the only few exceptions to that was in 2000. After that crash there were some negative returns for the next 1, 3, 5 years. And then some 3-year negative numbers here in 1966 and 68. But in total, we probably have 2, 4, 6, 8, 10, maybe 12 different line items on this map here. And I'll link to it again in the show notes. So that way you can go take a look at it. But for the most part, the majority of these returns, again, after the market went through a bear market, then hit a high, the majority of the returns 1, 3, 5, 10 years after are showing as positive. So that's a good thing. The other thing that you might be thinking is, well, if the market's hitting new highs, I've always heard invest when the market's low, buy low, sell high. So does it help to, if you're not yet in retirement, and you're still saving, does it actually help to then continue to save money and to put money away while the market's hitting new highs? So I've got a chart here that I'm pulling up from JP Morgan. Average cumulative S&P 500 total returns, January 1st of 1998 through the present. And it's going to show 1, 3, and 5 year returns, comparing if you were to invest on any day or if you're to invest at the all-time highs. And what the chart shows here is that if you were to invest at the all-time highs, your return would actually be more than if you were just to invest on any day. So investing in those all-time high days provides more of a long-term return from a 1, 3, and 5 year standpoint. Now, history does not mean anything about future results, but hopefully it gives you some thoughts and some statistics here. When we look at that one chart showing primarily positive after a bear market, this chart saying, hey, if you were to invest at the all-time highs, what does that look like? Primarily positive here again. So I'm just trying to utilize this to say, okay, don't focus on those news articles that want to push a negative thing, and don't get greedy either. Don't focus on those news articles that push too much positive and say, hey, we're running into this bull market, and throw all of your money in. You want to do what's right for you. There's one more thing. I got this from Dollars of Data, and I'll put this in the show notes. I'll link to this blog post here in the show notes. I thought this was really interesting. Going back to the beginning of 1970, U.S. stocks hit all-time highs at about 33% of all months. So 33% of all months going back from 1970, stocks were constantly hitting new highs. Global stocks, it said in the article, hit all-time highs at about 30% of the months. So what does this mean to you? What does this mean to retirement? And as I was talking about all these different records being set, that kicker set that record. That record was set. That record can be overcome by another kicker. But that kicker right there, his record's not going to necessarily go backwards. Caitlin Clark, right? She scores all those points. She's not going to go backwards in points. But the one thing to be, very cognizant of here is that while the market is setting new record highs, the market does have the ability to go backwards. So what does this mean for your retirement? Well, first off, hopefully what you're catching on to is that I want you to ignore all of the news. I want you to ignore all of the articles, because right now there's going to be a set of people that are going to be very, very bullish and will be telling you to put all of your money in the market. And then there's going to be people that are very, very bearish, and they're going to say that the crash is coming. We just hit a new high, so the crash has to be coming. There's going to be people that have, no sort of license, and they're going to they're going to cherry pick time frames. And they're going to say, look at how much money I made. And all they're doing is cherry picking time frames. And that's when greed starts to kick in. And so what I'm trying to help you understand when it comes to your retirement is have a strategy. Have a strategy. You've heard me talk about this multiple times, but I wanted to go through all of this about the market so that way you understand it and understand how it still comes back to having a strategy, because it can go up. And even though it's setting new records, as we saw for the last 2 years, it can also go down, and it can stay down, and it stayed down for over 700 plus days. So you want to have a strategy. In my opinion, equities are still the best hedge against inflation. That's the way you're going to outpace inflation and keep your money growing. But, thinking about Warren Buffett's quote, be fearful when others are greedy, greedy when others are fearful, thinking about what it said there with Dollars and Data, that, there's new highs, but it's really only 30 or 33% of the months. That means there's also times where there's not new highs, and there's times where the market's going down. You need to have an allocation that aligns with your needs. If you're approaching retirement, meaning you're not there yet, you need to have, if you're approaching retirement and you're not yet there, you have to start thinking about what kind of money might you need within the next 5 years. So maybe you're 3 years away from retirement. That means in 3 years, you're going to have to start turning on the paychecks from your retirement savings. How much will those paychecks need to be? How much will you need after year 3? Because if we do have another correction, say it lasts longer than the 700 plus days, let's say it goes into the 2,000 days. Well, have you started carving enough off into lower volatile funds so that way that money is there and ready for you once you do retire? It's also a good time while the market's at a new high, you might want to consider rebalancing. That's something that we do for all of our clients at the beginning of the year. And then it's always a good time to reassess your plan, because now your plan has new values because we've gone through a bear market. Maybe your last assessment was during the middle of the bear market. Now we're at new highs. So you got to find the average and maybe reassess your plan. Now, if you're in retirement, it's a really good time to reassess your plan. If you retired at the trough, right, at the low in this market situation, you might be able to take out more income because your accounts have had gains. Again, it's all based on your situation. And the other thing that you might be able to do is rebalance your accounts. So just to wrap up, yes, the market's going to go up and down. You're going to see lots of news articles about the market hitting new highs. But what does this mean to your retirement? It means that you still need to have an investment strategy that aligns with your future and aligns with your future income needs. Take advantage of times to maybe reassess your plan. Take advantage of these times to rebalance your plan. Take advantage of these times to see if maybe you can take more income from your plan as well. So the other headline that you might see consuming news articles right now could also be about the Fed. And they met in January and decided to hold interest rates steady. And then there's articles out there about now how March cuts are unlikely. And then rate cuts, though, through the year are potentially likely. Why is this important? And what does it all mean to your retirement? Well, first off, let's talk about what does it even mean? Who's the Fed? The Fed is the Federal Open Market Committee. And what they do is they set the federal funds rate. So I got this from Investopedia. I'll link to it in the show notes. I thought this would be a good way to help you understand the federal funds rate. It's the target interest rate at which commercial banks borrow and lend their excess reserves to each other overnight. Let me just keep this really simple because you can hear a lot of information. I mean, there's some really detailed information in regards to the federal funds rate and how it all works. But let's just keep this really, really simple today. The federal funds rate gives us the target price of what it's going to cost for borrowing money, meaning what you might see for bank loans, for business loans, for car loans, for credit cards, et cetera, et cetera. So it's the target percentage for what you're going to see of what it's going to cost to borrow money. If you're a saver, it's going to give you an idea of interest rates that you might get for online savings or CDs, but for saving your money. How is it determined? Well, it's determined by, it's determined and really influenced by different economic indicators, such as the core inflation and durable goods report, which provides signals about economic health of our country. How often is it changed or updated or reviewed? Well, that's 8 times a year that the Fed meets and decides, okay, if they're going to hold this Fed funds rate steady or if they're going to update it and change it. So let's just look back a little bit. Last year or 2 years ago, boy, time's really flying by now, right? But think about when inflation was skyrocketing up. What did you hear about in the news? You heard about the Federal Reserve raising interest rates. Why did they raise interest rates? Well, they were basically creating a higher price, a higher cost to be able to borrow money. If it costs more to borrow money, companies are doing less projects. Companies might hire less. Less projects means less people. It also means that it's costing more to borrow money from the bank or to get a car loan. So what does that mean? There's less borrowing. It means that there's less spending. And if there's less spending, that means there's less growth. And their hope then is that inflation comes down. That's actually what has happened over the last year as inflation has started to come down. The overall target for the Fed is 2%. The target inflation rate is 2%. And I want you to keep that in mind. We're going to talk about that when it comes to what does all this mean to your retirement. So the overall target is 2%. Right now, we're still a little bit higher than that. The current federal target rate, again, not for inflation, but for the actual interest rate, is sitting at 5.25 to 5.5%. Is there a target for the actual interest rate? And the answer to that is there's not a target for the interest rate. The target is actually the inflation rate that I was talking about at 2%. And if you take a look at the Investopedia article that I will link to here in the show notes, you'll see, I mean, for instance, in 1980, the Fed target rate was 20%. March of 2020 during COVID, it was anywhere from the target rate was 0 to 0.25%. So the target rate changes all to get inflation trying to average out at 2%. Now, will inflation be perfectly 2%? It's going to be higher than that, lower than that, but that's their target that they're trying to get to. Now, as inflation starts to come down, what does that mean? Well, the Fed wants to keep the economic wheels turning. They feel that if the interest rate, right, sits at a high point, then as the reason why I got up there is to create less borrowing. Less borrowing means less spending. Inflation starts to go down. Well, what that means is they might actually start to then cut that federal target rate. And that's why you're hearing about potential future rate cuts when it comes to the Fed. They want to keep the economic wheels turning. So if they see that inflation's going to their target rate of 2%, to continue to keep the economic wheels turning, they start to cut rates and make those rates lower. All of that being said, again, keeping it simple, Fed rate basically is that price of what it's going to cost, right, to borrow money. From a saver standpoint, it's what you're getting if you're saving. What does all of this mean to you and to your retirement? Well, first thing is, and maybe you caught into this when I was talking about it, is the Fed, their target inflation rate is 2%. So think about that. 2% target inflation rate, meaning there will always be inflation. What does that mean for your retirement? You need to plan on the cost and goods of services going up over time. They're not saying, hey, our goal is to get rid of inflation. They're not trying to do that whatsoever. They're just saying that the target rate for inflation is 2%, meaning there's always going to be the cost of goods and services going up. So you have to plan on that. So what do you have in your retirement plan to help you outpace inflation? Kind of goes what we were talking about earlier with the market. See how this ties in? That's why we have to have equities in our portfolio so that we're growing our assets to outpace inflation. Now, the other thing to know is that when inflation was going up, I think upwards of 8% over these last couple of years that we're seeing the inflation go up, it's also good to know that it's the goal of our economic system that doesn't stay there forever. So sometimes we're going to feel the pain of some really high inflationary periods. And then this is why they play with those interest rates up and down to help bring that inflation back down. We're also going to see periods of time where inflation's probably less than 2%. And we have in the past. Again, the target's 2%, but just like the market is typically doesn't ever just hit average returns, we're never going to just see the average inflation rate as well. We're going to see periods higher, periods lower. It's important that you plan and understand that inflation's going to be part of your retirement. The federal government's saying so, right? They're just saying, hey, 2%. We're targeting that, but we know the cost of goods and services are going to go up over time. The other thing to understand, inflation comes back down 2%. They want to keep the economic wheels turning. They lower interest rates. That means it's going to be easier, potentially at the end of this year or in the future, easier again to borrow money. Could mean more projects. More projects means more company projects. More company projects, since they're able to borrow money easier, means more projects. Could mean that they need to hire some more people. That means more people with money. More money spent could potentially mean some good economic times. Is it a great predictor of the future? Not always, but hopefully it gives you a kind of an idea of what could happen there in the future. If you're looking to, buy a home, if you need a new car, anything from like a loan standpoint, interest rates could potentially be going down, meaning the price of borrowing is less expensive. I'll link to this in the show notes as well. This was from bankrate.com, biggest winners and losers from the Fed's interest rate decision. Well, one thing that they talked about was savings accounts and CDs. So as you might know right now, if you have an online savings account or if you've recently looked at CDs, you're getting some pretty high interest rates. But just know that if the Fed does decide to cut interest rates towards the end of this year, you're going to start to see those rates drop. Have you ever heard of recency bias? Recency bias means that we kind of have a bias towards what's going on right now. And so a lot of times people are looking at their savings accounts going, wow, I'm making some really good interest here. Why wouldn't I just take and put all of my money in this online savings account or in CDs because of the interest rates? Remember, their target rate's 2%. We start getting down to 2%. Fed starts cutting interest rates, meaning the interest rates that you see on those online savings and CDs, guess what? Those are going to go down as well. Those won't stay up. So what will they go down to? We're not really sure. All depends on what the Fed cuts the rates to. But just to give you an idea, the Fed rates will impact what you're going to get for savings and CDs. Next on the list is mortgages. It talks about how, while yes, the Fed funds rate doesn't really impact mortgage rates, which are largely dependent on the 10-year treasury yield, they're often moving in the same direction. So if we see the Fed cut its rate, we might see a potential drop in mortgage rates in the future as well. And then stock and bond investors, it talks about that as well. Winners and losers. I'm not going to say it says either way in this article here, and I kind of already explained that, is from a bond standpoint, right? Interest rates go down. That means bond prices go up, but it also means that interest rates are down. So from a longer term standpoint, that the overall interest that those bonds would be producing could potentially be lower. If interest rates going down means it stimulates more economic activity, could potentially mean that the stock market rises. It's just ideas, right, of how all of this potentially generates economic conditions. Does it mean that's what's going to happen? Not necessarily, but it gives you some ideas of what all of this means. So hopefully that gives you a good idea of how the federal funds rate really affects you, whether it's from an inflation standpoint, you need to plan for that in your retirement. Whether it's from a rate standpoint, rates coming down, meaning how it could potentially affect the stock market or affect your ability to get a loan easier. Whether it's from a savings standpoint, if you're a saver and you've got money in the bank, it could just mean lower interest to plan on in the future when it comes to that savings. So stock market highs, federal funds rates and the Fed and the rates and all the new news articles around that. Hopefully this helps you kind of summarize it and understand just how it could potentially impact your retirement. And just bringing it all together, my goal is just to help you understand, but then know to ignore the news, ignore the headlines, and say, okay, what does this actually mean for me? I still need to have a strategy in place that aligns with my income plan of what I need for my specific future. Okay. Lastly, let's wrap up with Rose's question here. Rose says, it seems like every time I need to make a financial decision, I just end up talking myself in circles. For example, I have some tech stocks that I think I should sell, but I'll have to pay taxes on it if I do. Or another example, the investments in my 401k are probably too risky for my age, but I don't want to miss out on a good market by being too conservative. How do I stop talking in a circle and never making a decision? Rose, I think today's podcast really fits you perfectly, as I've summarized everything into one specific thing. And what is that? It's having a strategy. So the one thing that I would say that Rose is probably missing here in her situation is an actual plan and a strategy. What is the money for? What is the money going to be used for? Is the money for future growth? Well, then maybe let it grow for your future. Have it in equities. Is the money for upcoming income? Well, then maybe you want to carve it off into less volatile funds, and maybe you need some fixed income sitting around in your portfolio. All depends on what you need and what your specific strategy is, Rose. But I find that if you start putting a purpose to your money, then you can start putting a plan around it. And once you have that plan, you can start then putting the investment strategy behind that plan. And instead of going in circles, now you've got clear direction on what each dollar is out there for and why it's invested in the specific places that it's invested in. So Rose, I hope that helps you in regards to your situation. Maybe instead of thinking about it as investments first and taxes second, I want you to think about it as far as your plan first, the purpose of your money first, then going to investments and taxes second. Hope that helped you out. Hope everybody enjoyed the show today. If so, like I had mentioned, don't forget, help us continue to hit new highs of subscribers on our YouTube channel. Subscribe to our YouTube channel or subscribe on your favorite podcast player. And I look forward to our next episode together. Thanks and have a great day.
Insurance products are offered through the insurance business Sierens Financial Management, Inc., Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.